Since the beginning of human civilization, markets have gone up, and markets have come down. It is a constant as old as trade itself. And yet, every single time a market crashes, people react as though it has never happened before, as though this time it really is the end. Tonight, we are going to travel back through time together. We are going to walk through 4 centuries of panics, bubbles, and recoveries. And we are going to see that the market, despite all of its crises, has always done the same thing. It came back. Make yourself comfortable. This story is long, and it is meant to carry you gently into sleep. We begin in the Netherlands, in the 17th century, the Dutch Golden Age. Amsterdam is the center of world trade. Dutch merchants are the wealthiest in all of Europe, and in this prosperous country, a strange obsession begins to take hold with tulips. Tulips had arrived from the Ottoman Empire just a few decades earlier. They were new, exotic, beautiful. The rarest varieties, with their petals streaked in vivid colors, became symbols of status and wealth. At first, it made sense. A rare, beautiful flower commanded a good price. But slowly, something changed. People began buying tulips not to plant them, but to sell them at a higher price. A single tulip bulb of the Semper Augustus variety, the most coveted of all, sold for the price of a house on the Amsterdam Canal. We are talking about 10,000 florins. The annual salary of a skilled craftsman was roughly 300 florins. The taverns of Amsterdam transformed into makeshift trading floors. People who had never invested in their lives mortgaged their homes to buy bulbs, not flowers, mind you, contracts for bulbs that had not even been planted yet. And then, in February 1637, someone tried to sell a batch of bulbs, and nobody wanted to buy. Within days, prices collapsed by more than 90%. Entire fortunes vanished. Families were left with nothing. It was the first documented speculative bubble in history, but it would certainly not be the last. And the lesson, even back then, was the same lesson we keep relearning today. When everyone around you is buying something not for its value, but because the price is going up, that is the moment to be very, very careful. Let us move forward about 80 years. We are now in England, in 1720. The South Sea Company was a British enterprise founded in 1711. It had been granted a monopoly on trade with South America. In theory, it was a gold mine. In practice, actual trade was minimal. But that did not matter. What mattered was the story being told, and the story was magnificent. Endless riches from the New World, shiploads of gold and spices, a commercial empire without precedent. The share price multiplied by 8 in just a few months. King George I himself was a shareholder. Members of Parliament owned shares. Servants invested their life savings. Isaac Newton, yes, the scientist who discovered gravity, invested early and made a respectable profit. Then he watched the price continue to climb after he had sold, so he bought back in at the very top. He lost the equivalent of several $1 million in today's money, he later said. I can calculate the motion of heavenly bodies, but not the madness of men. The bubble burst in the summer of 1720. The share price fell from £1,000 to less than 100 within months. The British finance minister himself was sent to the Tower of London. Directors of the company had their assets seized. And there it is, a second complete cycle. The enthusiasm, the euphoria, the certainty that this time is different, and then the fall. Notice something. Between the Tulip Mania and the South Sea bubble, almost a century had passed. Enough time for everyone to have forgotten the previous lesson. Perhaps that is the true cycle of markets, not a cycle of prices, but a cycle of forgetting. We move forward now to the 20th century, the 1920s in America, the Roaring Twenties. The American economy is booming. Radio is spreading into homes. Automobiles are becoming affordable. Electricity is transforming daily life. Wall Street is celebrating. The Dow Jones Index has tripled between 1924 and 1929. And once again, a familiar pattern emerges. Ordinary people begin investing in the stock market for the first time. Taxi drivers offer stock tips. Shoeshine boys talk about their favorite shares. There is a famous story, perhaps true, perhaps embellished by time, that Joseph Kennedy, father of the future president, sold all of his stocks after receiving a stock tip from his shoeshine boy. He thought to himself, when shoeshine boys are giving stock advice, the market has gone too far. On October 24, 1929, Black Thursday, the market collapses. The next day, bankers try to reassure the public. The following Monday and Tuesday, the decline resumes even more violently. Within 3 years, the Dow Jones loses nearly 90% of its value. Banks fail by the thousands. Unemployment reaches 25% in the United States. This is the Great Depression, the worst economic crisis of the 20th century. But here is what almost no one knows, or remembers. The market came back. Not right away, not easily. It took roughly 25 years for the Dow Jones to return to its 1929 peak. That is a long time, a very long time. But someone who had invested at the worst possible moment, the absolute peak of September 1929, and who had simply waited, never selling, never panicking, reinvesting their dividends, would have recovered their money and much more. Patience is rarely spectacular, but it is almost always rewarded. Let us jump ahead to October 19th, 1987, a Monday. On that day, the Dow Jones lost 22.6% of its value in a single day. To put that in perspective, during the crash of 1929, the worst single day saw a decline of roughly 12%. Black Monday of 1987 remains, in percentage terms, the worst day in the history of the American stock market. The causes were multiple: concerns about the trade deficit, rising interest rates, and above all, a new phenomenon: computerized trading. Automated programs sold stocks whenever the market fell, which caused the market to fall further, which triggered more automated selling, a vicious cycle powered by machines. That evening, respected experts spoke of the end of the financial system as we knew it. Comparisons to 1929 flew in from every direction. And yet, 2 years later, the market had recovered all of its losses. Not 25 years like after 1929. 2 years. Someone who had panicked and sold on Tuesday morning had locked in a loss of more than 20%. Someone who had done nothing had recovered their money in 2 years and doubled it in 5. The cycle, once again, the panic, the certainty that this time it is the end, and then the recovery. We arrive now at the late 1990s. The internet is entering homes across the world, and with it comes a new wave of euphoria. Companies with no revenue, no profits, sometimes not even a real product, saw their stock market value explode simply because they had a .com in their name. Pets.com sold pet food online. The company spent millions on advertising, including a Super Bowl commercial. It went bankrupt less than a year after going public. The Nasdaq, the technology index, reached a peak of 5,048 points in March of 2000. By October of 2002, it had fallen to 1,114, a decline of nearly 80%. Billions of dollars in wealth evaporated. Engineers who believed they were millionaires thanks to their stock options, found themselves with nothing. But once again, amid the wreckage of the internet bubble, some companies were real. Amazon lost more than 90% of its value between 1999 and 2001. Its stock fell from around $107 to $7. Today, adjusted for stock splits, that same share is worth thousands of dollars. Someone who had bought at the worst moment, at the very peak of the bubble, and had simply held on to their Amazon shares, would have become wealthy, not by selling at the right time, not by being smarter than the market, simply by doing nothing. 2008, the subprime crisis. This one many of you lived through. Perhaps you had a mortgage. Perhaps you knew someone who lost their home. American banks had granted mortgages to people who clearly could not afford to repay them. These loans had been sliced, repackaged, and sold as safe investments to financial institutions around the world. When borrowers began to default, the entire house of cards collapsed. Lehman Brothers, an investment bank 158 years old, went bankrupt overnight. The global financial system stood at the edge of implosion. The S&P 500 lost more than 50% of its value between its peak in October 2007 and its low in March 2009. March 2009. Remember that moment, because that was the moment when everyone, absolutely everyone, was convinced it was the end. Newspapers spoke of a global depression. The most respected experts advised selling everything, and that was precisely, the best time to buy. Between March 2009 and the end of 2019, the S&P 500 multiplied by more than 5 times your money in 10 years, simply by buying when everyone else was afraid, or better yet, by not selling when everyone else was selling. So what do we observe when we look at these 4 centuries of financial history? A pattern, always the same pattern. First, there is a period of real growth. The economy is doing well, companies are making profits, people have jobs. This is normal and healthy. Second, optimism transforms into euphoria. People begin to believe that growth will last forever, that trees will grow to the sky, that this time it is different. Third, prices detach from reality. People buy not because an investment has value, but because the price is rising. This is the very definition of a bubble. Fourth, an event triggers panic. Sometimes it is obvious, sometimes it is trivial, but confidence evaporates and everyone wants to sell